Okay, I think we will go ahead and get started. Thank you everyone for joining us today. I know we've got a big class and there may still be others that are joining as we start the introduction, but we'll go ahead and get started. I know your time's valuable and we've got a lot of information to cover here. And in fact, there's a presentation a little later this afternoon to cover. Um, it's
CareMatters II.
partner product. Okay. Thank you, everyone. My name is Lynn Voss from Golden Care. I am the senior marketing specialist here, and I am joined by David Goluboff with Nationwide. Um, Unfortunately, Jack Brewer is not able to join us. He was pulled away with different meetings, but it's always better to plan for two presenters just in case. So let's see here. This presentation, we're actually going to be covering the CareMatters II linked benefit hybrid product, and you're going to give us all the details. So let's go ahead and.
But hey, I just wanted to say thank you so much for joining us today. I hope today is going to be educational for you into understanding kind of the hybrid space and where our product falls in line and what's made our product so popular. Right now, we have the number one CareMatters II and CareMatters together make up the number one selling hybrid solution in the market. So we're really excited about that. A lot of that has to do with a lot of the features that we're offering in this product. And that's what we're going to review. I'm just going to show you the technical aspects of it. I know that most of you have a lot of experience with long-term care. You understand the need. You understand how it works. These policies, the linked benefit products, are a little bit different because they're built on life insurance chassis. So they have a few other features in it. Originally and intentionally, their biggest goal of a linked product is to offer you the three things, right? If you were to pass away, it's got a death benefit bigger than what you put in. If you need the long-term care benefit, you've created a pool for yourself that's going to multiply whatever you put in at least 4 to 6 times. That's the main goal. And then lastly, if you wanted to go ahead and pull your money and you have an emergency, there's ROP features that are return of premium features that are actually built into the policy, which will allow you to do that. But it kind of gives the client a solution, an option to have kind of that knowledge in the background, knowing that if something does happen, I have kind of a solution for everything. So that's what we're going to discuss today, just kind of the characteristics of the policy and how it works. And if there are any questions or anything, Jack and I are here to help you and support you in any way we can as far as sales go, as far as understanding the product. This is our contact information. Jack is at the top. You will see he's on the East Coast. Anything pretty much east of the Mississippi is Jack's territory. West of the Mississippi, you can call me anytime. On Pacific Coast, he's the East Coast. Our Cask Barnes is our internal partner, and she's there to also assist you with any illustrations, any questions. If you have any cases that are in-house and that may be taking a little bit longer than what you think or the expectation is, give us a call. I'm more than happy to go in and see what's going on and be able to push that for you. That's what we're here for. We're advocates for you and your business and your clients, trying to get things through for you ultimately, right? Cass is also on the East Coast. She has East Coast hours, so you can always reach out to us. We're available. If you can't get a hold of one of them, and let's say it's later in the day, feel free to call me even if you're on the East Coast, and I can answer some of those questions for you. I'm here a little bit later, 2 or 3 hours later than they are, so feel free to call me anytime. So one of the things that we talk about always is the strength of our organization. Nationwide, it has been in the long-term care solution space for over 25 years, and you all know we have a property and casualty division. Our division is a financial division of the long-term care, annuities, and life insurance. Our rating as a carrier is A+, A1, and A+ at Standard & Poor's. We have some of the strongest financials out in the market. So when you're talking to your client, they recognize the name, they recognize the strength of the company. And I think that's really important when you're discussing an option that's going to be a lifetime commitment for that client. So please note, we have one of the strongest ratings out in the industry right now. We're also now considered the third largest life carrier in the country. So that's really exciting for us. And with that, that allows us to kind of broaden our markets, bring out new products. And we will be releasing a product out. It's exciting because we're going to actually have an annuity solution at the end of October that we'll be releasing. And it's very similar to some of the products that are out there, but it's going to allow us to go to age 80. And it's going to allow us to, if there's some health issues there that maybe they couldn't qualify for CareMatters II or CareMatters Together, this annuity product will actually allow us to have just 5 knockout questions to quit. It's what it's really meant for is leveraging. If you have an asset that you want to put in there and maybe there are some health issues, you go up to age 80 and now you can multiply that and leverage that maybe 3 to 4 times. It's not going to give you the same leverage as the CareMatters do and the CareMatters Together, but it's a solution for those clients that are looking to really create that pool for long-term care needs. So we're really excited to announce that. I still don't know even if we're going to be contracted or be able to sell it through Golden Care, but it is going to be out in the market, and I believe we should have all of that information for you and be able to do it through your organization. So again, as I mentioned, we've been in the business for over 25 years. We started off with our life insurance policies, and we created riders for that life insurance policy that were actually true long-term care riders. And then we created our standalone nationwide CareMatters policy, which came out very long ago, I would say about 14 years ago. And then we created the rider on our survivorship, our rider on the individual life, the updated version of it. And then we came out with CareMatters II, and that's been the popular product in the last 4 to 5 years. And then we recently released the CareMatters Together, which we'll be discussing in the afternoon call at, I believe, 2:00 your time. So East Coast time. So that the last one has been nationwide CareMatters Together, and we'll just be discussing that. That's actually 2 lives on one. Married couples, meant for primary family that may be living in the same household. It could be mother, daughter, but it's 2 people on one policy, and it kind of helps and creates a flexibility that you have when you're looking for 2 people to be covered on one policy. We'll discuss that in the afternoon. But as of right now, what I just want to go over is just kind of how does CareMatters II work? How does it function? What are the benefits of it? And what are the features that are really making it such a popular, strong product out in the market today? I'll tell you, nationwide, we've the business, the industry itself last year was about $1.7 billion in premiums. I can tell you that CareMatters II and CareMatters Together made up almost 500 million of that $1.67 billion. So I can tell you we have almost a third of the market in the linked business part of the industry where we're really making strides and people are really noticing this product. So it's exciting for us. The advantages of linked benefit products, if you're not aware or if you've never worked with a linked benefit product, again, it's built on a long-term care, on a life insurance chassis. Everything on there is guaranteed. The premiums are guaranteed. The benefits guaranteed. If you add inflation, it's guaranteed. Everything on this policy is guaranteed. When you look at that illustration and you talk to your clients on that, there's going to be a ledger. And just like life insurance, everything on there, there's no volatility. It's not on an index. It's not a VUL. It is a guaranteed universal life product that it's based off of. So everything that you read to your clients on that product, on that illustration, is going to be correct, and they can look at it in future if they needed to know some of that information. That is all guaranteed. So number one, the advantages of a linked benefit product are going to be it offers guaranteed premiums, right? The premiums are never going to go up. They're based again on life insurance. So if they choose a premium, that's what it's going to be. Another wonderful part about this is since it is on a universal life chassis, it has paid up benefits. So if your client, let's say, decides to pay for it in 10 years and they only make 8 years of premium payments, the policy doesn't lapse. The policy doesn't stop. There's cash value in there to take it. The only difference is you can call Nationwide and say, hey, I've got a 10 pay. I need to stop making payments at year 8. What would my benefits be? Your benefits are going to change a little bit, but you can do that, and it's available to them. It's not going to lapse. The death benefit, it also answers another portion of the linked benefit products. It's, you're creating a pool for long-term care. You're creating a death benefit that's going to be more than what the client put in. So if something does happen and they don't use the benefits for long-term care purposes, their family is going to receive that death benefit which again is more than what the client actually put in. And then it provides huge leverage. This pool is what the idea is that you're really creating that pool of 4 to 6 times what you're investing in it from day one. If you add inflation riders to that to keep up with the market, I mean, you're probably looking at 7 or 8 to 10 times what you originally put in at the time you need. As we all know, long-term care is based off of, most of our products we see sold are in their 50s, but we're really planning for that older age. We're planning for the 75 to 85. Statistically, that's when we start seeing the claims. So these products are meant for that. And with something like inflation riders, it allows you to keep growing and be prepared at that age to cover as much as possible of any care that you might need. So that's truly the advantages of a linked benefit product. It kind of answers all the questions for the client on what happens if this situation comes up. There's kind of a solution for all options. Now, this is how the product works. And this is what I want to explain to you if you've never worked with a linked product before. The way this basically works, and originally these products were meant for people with more of a, let's say, a sideline money. It was more of a leverage play, maybe an annuity, maybe an IRA that somebody had that was out of the lock period. And, they're now in their 50s, 60s, and now they see the need because they're helping out their parents with long-term care, and they see the financial responsibility that it takes to help fund this type of care. So what this basically was originally meant to do is take that lump sum amount, put it into this policy, and just multiply and leverage it about 5 or 6 times. And this is what I'm going to show you here. This is not based on any gender or any age. This is just a general example of what this product looks like. It's able to do. Now, there's different ways to pay for it. Originally, as I mentioned, it was people that had $50,000, $100,000 sideline money. It's changed vastly. Now you're looking at opportunities to pay to age 100, pay to age 65, pay monthly. It's opened up for middle America quite a bit, the opportunity to purchase a policy like this. So we'll go into that a little bit more, but what I want you to understand is how this product works. So on the left-hand side, if you look at the top, it's going to say single premium, return of premium feature. It has $100,000. Let's say this was a CD, it was out of the lock period. Clients now in their mid-50s, they're helping out their parents financially. Now they know the cost of long-term care. They see the need. They don't want to do the same to their children, to have to come back home and help. Maybe they can help manage it, but not actually provide the care. So I'm going to take this $100,000 and I'm going to put it into a CareMatters II policy. That $100,000, if you look to the right-hand side, you're going to see a total of $540,000. Okay, so generally these products run about 6 years. And as most of us know, that's kind of like the sweet spot, right? Statistically, if somebody needs long-term care, they're going to need it 3 or 4 years. It gives them a little bit extra flexibility to have some more in the pool. But the way this product works is, I just want you to look at it. It's a leverage play. $100,000 from day one creates $540,000 pool for long-term care benefit needs. Okay, so that's number one. That's the main idea of this product. Now, how it works, and if you were to take that $540,000 and divide it in 6 years, you will see that the monthly benefit in that blue bucket is going to be $7,500. So that $7,500 would be for 6 years, and there are no taxes on that. It's non-taxable. It's like the death benefit, $7,500 non-taxable benefit. The way it works is it's divided out. It's always going to be, and this policy is, you're able to purchase it from 2 to 7 years. Okay, so those are your options. You can pick a 2, 3, 4, 5, 6, 7 year policy. Generally, the 6 years is kind of the sweet spot for pricing. But if you were to put the $100,000 in, that gold bucket is going to represent the first money that's going to be used for the benefit. That money is actually considered your death benefit money. So it's almost your money. I'm putting in $100,000 from day one. If something were to happen to me and I never use this policy, or I passed away within the first year, my family is going to be receiving $180,000 of death benefit. Okay? And that $180,000 represents the first bucket, and that's where I'm going to start using the benefit when I need it. So it's almost, you're spending down your own money, you're spending down your death benefit when you trigger any of the benefits that may start at any age. Okay, so that's number one. Once you deplete, or once you completely past that $180,000, this is what you're essentially paying for, what your client is looking for. It's to increase that pool, right? So that second bucket is going to be a 4-year benefit extension of benefit riders, and that's $360,000. So if you add up that 180 plus that 360, that makes a total of $540,000 of coverage. So that's the pool. I had $100,000. I leveraged it from one day to the next, almost 5.5 times. That's what we're looking for. Okay. Again, the way it works, it's always, no matter what you pick, the first 2 years are going to be your death benefit that you're spending down first. Now, if I use the $540,000 completely, I went in and I needed care for 6 years, $540,000 of coverage. We offer something that it's the highest. It's a residual death benefit, and it's the highest in the market. But we offer a 20% residual death benefit. What that essentially means is once you spend down the $180,000 of your death benefit, there's no longer a death benefit. You use that portion, whether you use the complete $540,000 of the pool, or whether you use $400,000 of it, the $180,000 of death benefit is gone. But no matter what, our promise to your client is that no matter when they pass away, if they use up that first bucket, their family is always going to receive 20% of that 180 is always going to be available to the beneficiaries of your client when they pass away. So somebody could go on claim, use up the $540,000, be on claim for 6 years, and they may pass away 10 years after the policy has been completely used, right? There's no funds left in there. $540,000 were used. When that client passes away, 10 years, 15 years later, their family will receive that $36,000 death benefit. Okay, so that's always part of the features that we offer, and the policy stays active until the passing of your client. So that's really what makes it. Just the features that we're offering are a little bit better than what's the norm in the industry, and it gives a little bit more to the client. So if you really think about that, add that $36,000 to that $540, it's really a $576,000 policy, because that's what we're going to be paying out to the client and their beneficiaries. So I hope that made sense. I know that the first couple of times you hear it, it's a little different. Just remember, it's always going to be, the first 2 years are always going to be one bucket. Death benefit's going to be part of that. And then the second year, whatever it may be, that next bucket, whether it's 5 years, 3 years, that's going to be the extension of benefit riders. And then it's divided all. And just to give you an example, this $540,000 is not including an inflation rider. If I were to include an inflation rider into this policy, let's say 3%, that $540,000, so let's say the client was in their 50s, you let it grow for about 20, 25 years, that $540,000, by the time they statistically will need it in their late 70s, 80s, it's going to be well over $1 million. That pool is going to grow substantially. That compounding interest does an amazing job. And I know that you understand that. You've seen it before on the ledger. On the illustration, you'll be able to show your client exactly at what age every year represents the growth of that 3%. So if your client's in their 50s and they say, "Hey, I want to see what that benefit would be at age 67," you go under 67 and it shows you on that illustration what the growth is and what their monthly and what their entire pool will be. So it's very effective when you're talking to your client and they're seeing, when they do really need that coverage. When they do need that benefit, it's going to be there for them, and it's going to be much larger than they initially chose. Let's talk about the features, the real features of this product. And I'll be honest with you, I've been in this business over 20 years. The cash indemnity portion, to me, is everything. The cash indemnity is 20 years ago, Nationwide was pretty much the only option out there that was offering cash. And people really didn't understand, right? The two options are reimbursement or cash indemnity. Reimbursement has always been the standard for the industry, where you have costs, you submit those invoices, the carrier pays for them. But what cash indemnity does is basically says, hey, you're choosing a benefit of $8,000 a month. If you qualify those 2 out of 6 ADLs, and your doctor writes that plan of care, you will get those $8,000 every month until you do not need it. We don't care what you spend it on. That's the beauty of the cash indemnity portion. And I honestly think that that's what's made this product so popular, is just to know that they'll have the flexibility to do what they need. I've been a caregiver for 20 years. I understand the complexities of some of these expenses that may not be reimbursable. Alternative care like, acupuncture, chiropractic care. My father-in-law, he used to be, he would mow the lawn. We had to get somebody to mow the lawn. All those little costs, the changes in the home, the bathroom adjustments that you needed to make with the bars, the carpet changing to the hardwood, all those expenses, these are all able um, to be paid for through the benefit of the cash indemnity because there's no questions that are asked. And that's really the benefit of this product itself, is where it makes it so competitive, is the flexibility. The issue ages for this product are going to be 30 to 75. Generally, most of our business is coming in the early 50s. I believe that's kind of when perception changes, right? You kind of go from a growth mode of, let's say, life insurance, investment, and all these things, and now you're starting to think, okay, well, what if something happens? I'm starting to see it with my parents, and I see the cost of it. So I need to build kind of that financial protection for everything I've built. So that's when we start seeing a lot more of our policies. If you can talk to somebody in their 40s and get them to understand what CareMatters can really do for them, or what long-term care insurance can do for them at that age, they're going to get a much better deal. 50s is still really well priced. When you start getting into mid 60s, it gets a little bit more expensive just because the risk is higher. But that's generally 30 to 75. We're looking at late 40s to early 50s is where the majority of our policies are coming in. 90-day calendar elimination period. I will tell you that we're the only ones in the industry that offer this. First 90 days of any long-term care policy is pretty much out of pocket. What we offer the client, and I'm going to show you an example here. What we offer the client is the first 90 days that we know can be very expensive. All those adjustments to the home, all those new costs that maybe we're taking care of the person that now needs the benefit. We know that there's going to be an increase in costs, and it's going to come out of the client's pockets. So what we're offering, and one of the best features of this product is the 90-day retroactive elimination period to zero. So what that basically means is on your 90 days that you've been out of pocket, on that 91st day when you receive your first benefit, you're going to receive 4 months of benefit to help you. Now, it's not a reimbursement because we don't know what you spent, but what we're trying to do is we're trying to help recuperate some of those expenses in order to make it a little bit easier for the client. So in this example, you'll see it's $10,000 a month. You'll see that they've received that the benefits start on day one. The first month there's zero paid out, second paid out, third month zero paid out. On that fourth month, your client is going to receive a check for $40,000. Okay, so we're getting 4 months of benefit on the first month. Then it goes back to the original benefit of $10,000 until the policy is complete. So that is one of our promises to the client too, to know that those 90 days, there is going to be some help when they receive their first benefit payment. This product also offers 3 return of premium features. Basically, the return of premium features has a cost to it, but it mostly comes out of the benefit of the client. So we have 3 options. One of them is for the client to be vested from day one. That means that they can receive 100% of their money back after the first year. There's a step up, which is after the 5th year. Generally, all of them are going to be available after the 10th year of the policy, where you'll get 100% of whatever you've invested into the policy is available as a return of premium feature if their client decided they needed that. So they can go in and take that. I will tell you, there is an option that you'll see on the illustrations that says maximum monthly long-term care. That is our best. That is the one feature that takes the least out of the benefit. And that one is, the option is after 10 years, you're going to have 100% of your money. But if you did need your money prior to that, there's like a 10% to 15% cost on doing that prior to the 10 years. But that is the other option. You can pull that money when you need it, and it's yours. If you, especially on a single pay, if you submitted $100,000, you have that $100,000 available to you for any emergencies. 3 inflation options that we offer, and again, I'll tell you these are the most important features that we have on this product. It's 3% simple, 3% compound, 5% compound. 3% compound, again, is the sweet spot. This is where we see the 5% can be a little bit too costly. The 3% simple is too close to the pricing on the compound, and the compound makes such a difference that I will tell you, when you put them side by side, the 3% compound makes the most sense out of the 3 options. The death benefit is at least 20% and of specified death benefit. So that's the option that we talked about in the early on that page where you see the three buckets. If the entire policy, all the funds for long-term care, that pool, are completely used, and there's not a dollar left in there, client passes away 10 years after they've used up all the funds, their family's still going to be receiving 20% of the death benefit when they pass away, whenever that is. So the policy stays active and alive. Annually, monthly mode, this is kind of where the market has really shifted, and we've made it available to middle America, and really made it affordable. I can tell you that a lot of these cases that I see, it's $100, $200 premiums on a monthly basis where somebody's at least getting some long-term care. Maybe it's $2,000, maybe it's $3,000 to start with, but then you add the inflation rider, and by the time they reach that age, they've got a $7,000, $8,000 policy. It just really makes sense. And the monthly mode and annual mode is what helps that out. Individual and couple rates. If your client is married, there is about a 10 to 12% discount. Now, one of the things it's going to show you on the illustration that you can choose married or not married. If your client is in a domestic partnership, if they've been living with somebody for years, they share a household, they have a child together, feel free to put that couple's rate in there. Just because we're not looking for actual marriage, we're not going to be requesting marriage certificates or anything. But during the time that they did purchase policy, if there is a couple, we want to know, and we want to go ahead and give them that discounted rate. So it's not just for married couples; it is for domestic partnerships also. Okay, I live in California, and it's a community state property state, so you can actually use that also, and there's laws there. But this, for our policy purposes, if they've been together for a while and they live in the same household, this applies. Premium options. This is where we see most of our business is still coming from that single pay. It's a leverage move. I've got 50,000, 75,000 in this annuity. I'm going to go ahead and move it over and leverage it 6 times in order to fund my long-term care. Single pay and 10 pay are our most popular, but we are seeing a lot of volume now in the pay to age 65 and pay to age 100. Mostly in the pay to age 65, you've got somebody in their late 40s, early 50s. So they want to know that when they hit retirement age, they don't have to think about any long-term care cost or anything. They run it to age 65 and then they're done. And the pricing's pretty good. If you give this anywhere from 15 to 20 years, it's very competitive, very strong area to pay age 65 if you've got 15, 20 years to pay for that. Another great feature of this policy is that the LTC premiums are HSA eligible, meaning you could use some of your pre-tax dollars in order to pay for some of these costs for long-term care. Same thing with business owners. If you're working with business owners, a lot of the times they have a life insurance solution, a buy-sell agreement. But what happens if that client, suffers a stroke and can't come back to work, and they were the person that was in charge of marketing or sales? How is that person going to continue to live? Are they going to continue to receive, whatever percentage they had of the business? All those things, if you can make the check payable from the actual business, there's huge tax deductible incentives for that client. And we're going to talk a little bit more about that just because I think it's such a great opportunity for you to discuss. Again, the cash indemnity portion is tremendous. Again, it's the alternative care that allows you to kind of use those needs without approval. Things like, if you need prescriptions, health safety modification, lawn care, all those things that I kind of discussed at the beginning. This is what cash indemnity allows you to do. And this is really what this product has made it so successful in the market, just because we are offering cash. Your client can actually live abroad and receive the benefit from abroad. So if you have a client that's looking to retire in a different country, and they're looking at a product. Now, I will tell you that first bucket, that death benefit bucket, that is where you can actually be out of the country and receive the monthly benefits. Okay. If, let's say, your client is in Korea and they retired in Korea and they suffer a stroke, heart attack, anything where they need to trigger the benefits on this, the way we do it, we work with a third party. We're going to go out they do not no longer need to go out and look for an American licensed doctor in a foreign country. We're going to go out there. We're going to contact that doctor. We're going to ask them for the medical records. We'll translate them. We'll write the plan of care. So we're taking a lot of the bulk of the obligation of that client, of the insured, and we're taking it upon us to figure it out and give them that benefit and start that benefit that they paid for. So one of the things that I do want you to understand, if you are looking at international benefits and you have a client that's going to be out of the country or that is considering maybe retiring outside of the country, the first 2 years of the years that they could spend outside of the country, the rest of the years, let's say they picked a 6 year, they have to come back to the US in order to receive the benefit. Now, our solution to that is if you are looking to retire in a foreign country, purchase a 2 year contract. Build it up higher than you would if you're going to extend it 6 years. Just make it 2 years, and then it's going to be an excess, right? Especially carrying in foreign countries is going to be a lot better than in the U.S. You can really allow that client to have an excess, and where they can either save that money or they can invest it and actually extend their care for a lot longer in those foreign countries. But remember, it needs to be at least 2 years. So that's the flexibility that it's offering as far as outside of the country retirement options. Remember, this is going to help pay for all the future care expenses, and whatever is left to their heirs, if they don't use it in the care, they're going to be able to use it in the death benefit option, in the death benefit portion also. Real quick, to go back on the tax portion of this, I wanted just to let you know how we're able to do that. So most of the policies that are linked benefit products out there, they don't have this ability, because what we've done is we've actually created long-term care premiums for this policy, right? So I just want you to understand that if you're talking to somebody that maybe is a W-2 employee and they are receiving, they receive a check biweekly, bi-monthly, that portion of what they put into their HSA account, which is pre-tax, can be used in order to pay for some of the cost. And what I'm going to do is I'm going to show you how we're able to do that. If you look at the bottom where that pyramid is, that LTC premiums have no cash value. The reason why we're able to do that is because we created the premiums before, and some of our competitors still have these riders as either cost of the insurance or in the cash value. And that's where it comes out. It's hard to determine what exactly those premiums are if it's a part of the cost of insurance. What we've done is we separated them. So in your illustration, there's a page on there that's actually called separate identifiable LTC premiums. And what you're going to do is you're going to see the life, since policy is built on a life insurance policy, on the life insurance chassis, you're going to see a life insurance cost. That life insurance cost has no tax deductibility. And generally it's anywhere from 30 to 60% of the cost. Underneath that, you're going to see 3 different long-term care costs, and they're all rider premiums. So if you look at the pyramid, it says LTC rider, it says extension of benefit rider, and it says inflation rider. All of these have tax deductibility under the IRC 7702B opportunity. So this contract is actually a true long-term care contract, and it has that tax deductibility. Now, the best tax deductibility, if we're talking about a business owner, if they are a C corp, that tax deductibility has 100% of these long-term care riders cost of these premiums that can be tax deductible. 100%. If it's a pass-through, if it's an S corp, if it is a sole proprietorship, a partnership, anything like that, there is tax deductibility, but it's based on age-based limits. So age-based limits are here, and you will see that whatever that premium cost is, depending on their age, there's going to be a ceiling. So anyone from 51 to 60, the max that they could do on 2024 is 1760. And I apologize, I don't have the updated one. It's above 1800 now. So if you're 51 to 60, out of those long-term care costs, if they, let's say they accumulate to $4,000, $1,800 of those $4,000 are able to be tax deductible for your client if they're a business owner. The only request that we have in order to qualify for this is that the check actually has to come from the business. So the beneficiary, the owner, all of that can be separate. The check, the premium, to pay for the policy has to come from the business in order to qualify for those business tax deductions. Also, this is for HSA. If you have a client that's in their 50s that they have an HSA account and health savings account, for those if you've never worked with a health savings account, most corporations now offer it. It's just to help you out with deductibles for any maybe surgery that you might have where it's out of pocket. It helps you using pre-tax dollars to build up the savings account. Again, if you don't use it, you can use it to spend to pay for some of these premiums. Again, 2024 1760 you can use. The way it would work is you go ahead and you write it, you pay the policy out, whether it's annual or monthly. At the end of the year, you go back to your HSA company and say, hey, these are the expenses I use for long-term care. I have a maximum of 1760, and the HSA company will write you a check for that 1760. So that's the way it works with any tax implications that you might have or tax benefit that your client may have. There's an opportunity for W-2 workers and also for business owners to get some tax deductibility, which is fantastic. Where we're seeing most of our funding coming from are three opportunities that we have. Most of it, I will say, are still assets. We're seeing a lot of qualified money coming in, 401k, IRAs, qualified, non-qualified annuities. That's where we're seeing a lot of it just due to some of the ages that we see. Remember, if you're going to use a 401k or an IRA and it's qualified money, 59.5 rule still is very important. You're going to need to do that. But the way we do that with 401k is we would 1035 that money into a SPIA, a single premium immediate annuity. We fund it for 10 years so the tax implication isn't so large for your client. And then we pay for that CareMatters product on a 10-year pay. So that's how we would be able to do qualified money. We put it into a SPIA. The SPIA pays for the CareMatters, and there is tax that you'll be hit with that the client will have to pay for, but it'll be on a 10-year basis versus a lump sum payment. Income dollars, most of that we're seeing in the early 50s. The highest salary, excess salary that somebody's going to be receiving is generally in their 50s. So they're using some of that to pay for it on 10 pay. We see that. And then cash, certificate of deposits, called bonds, cash from selling a home or a business. We see that as a leverage point where a lot of business is coming in from that angle also. So it's all three. Most of it, again, is assets that we see. It's just leveraging one from one pocket to another. But I will tell you, we see a variety of these different solutions for clients. And lastly, again, this product is meant really in the market. I believe that this is the most flexible product out there. And just the way we look at things for the first 90 days that we, the retroactive to zero, the death benefit that we're offering, the inflation, all of this kind of just allows a client to really choose how they want to be, how they want to create the care for their needs, right? Especially like informal. I will tell you, I'm a 20-year caregiver. Having that cash be available for my situation would have been tremendous. We never had long-term care insurance, but I'll tell you, a lot of family members participated in assisting my father-in-law in his recovery, and it was just out of the kindness of their hearts, whether it was taking him somewhere, whether it was helping him with some of the physical training that he needed in order to get back. But it would have been very nice to be able to offer them some kind of compensation for their efforts. And so this is what this policy allows you to do with the cash indemnity option that we offer. Again, the minimum death benefit is still there. If they use the entire policy, it's going to still pay a death benefit. And so with that, I know that there might be a lot of questions, but I hope this helped out, just kind of understanding what are the main features of the policy, where your clients can fit. I will tell you again that we are seeing so many different aspects, so many different, from middle America to high net wealth clients, that understand what leverage is, right? Before it used to be, the wealthy are going to pretty much self-fund, and that's always an option. But if you could provide a $200,000 check and never have to worry about it, and it goes over $1.5 million, it saves you from having to sell the asset, from the time that it's going to take, and you have just that liquidity available for you at all times. We're seeing a large increase in large cases also. So things are looking really great. And remember, I mean, the the truth about long-term care is that we're here. The baby boomers are here. The youngest baby boomer is now 59. Next year is going to be 80 is the oldest. We're in that phase where these generations are starting to see what the cost is, and it keeps increasing. So we have to find a solution to help out our clients and give them the best possible aspect. The flexibility of this product is what I truly believe makes it different to anything else out in the market. I thank you for all your time, and I thank you for attending today.
Technology is great when it works. So thank you so much, thank you so much, David, for coming on. And I know Jack wasn't able to come and join us today, but you gave an excellent presentation. You covered a lot of information quickly. Again, everybody, we recorded the presentation, and be on the lookout for your emails. Watch for your email afterwards, and definitely be sure to join us on the afternoon presentation at 2 p.m. Central. So, David, thank you so much. We will be seeing you
Thank you.
here in just another couple hours.
Thank you. Thank you, everyone, for joining.
All right. Have a wonderful afternoon.
Golden Care is looking forward to serving you with new tools, new products, new innovations, and always the best support in the business to help you succeed in 2022. So give us a call at 800-842-7799 or check out our website at www.goldencareagent.com.